Disclaimer: this is not financial advice. Think of the Lion-Phillip S-REIT ETF as a carefully curated basket of Singapore's premier real estate investment trusts. Launched in October 2017, this ETF offers investors a way to gain exposure to Singapore's robust real estate market through a single investment vehicle. What makes this ETF particularly interesting is how it combines the stability of real estate with the liquidity of stock market trading. The ETF's portfolio construction follows a sophisticated approach. Rather than simply including all available REITs, it uses Morningstar's screening methodology to identify REITs that offer not just high yields, but also demonstrate strong financial health and quality. This is similar to having an experienced property investor who carefully selects properties based on both their rental income potential and underlying value. The sector allocation tells an interesting story about Singapore's real estate landscape. Industrial REITs form the largest component at 35.7%, followed by retail REITs at 32.8%. This weighting reflects the strong performance of Singapore's industrial sector, particularly in areas like logistics and data centers, which have shown resilience even during economic uncertainties. The retail sector's significant presence demonstrates the enduring value of Singapore's shopping centers and commercial spaces, despite the growth of e-commerce. One of the most compelling aspects of this ETF is its geographical diversification. While it's listed in Singapore, over 85% of the underlying REITs own properties beyond Singapore's borders. This means investors aren't just investing in Singapore real estate. They're gaining exposure to property markets across Asia-Pacific and beyond, all while trading in Singapore dollars. The ETF's dividend distribution policy aligns well with income-focused investors. It pays dividends twice a year, with recent distributions showing steady income generation. For example, the upcoming dividend payment scheduled for February 26, 2025, is set at 0.0250 per unit, which represents a slight increase from the previous distribution of 0.0215 per unit in August 2024. However, recent performance data reveals some challenges. The ETF has experienced a decline of 23.85% over the past 3 years, which can be attributed to several factors including rising interest rates and broader market conditions affecting the REIT sector. This performance trend highlights an important characteristic of REIT investments. While they offer attractive income through dividends, they're not immune to market cycles and interest rate movements. For investors considering this ETF, it's worth understanding the fee structure. The expense ratio of 0.60% might seem modest, but remember that this comes on top of the management fees charged by the underlying REITs. Think of it as paying both the property manager, the individual REITs, and the portfolio manager, the ETF. Looking ahead, the ETF's focus on quality REITs with strong financial health positions it well for potential market recovery. The diverse sector exposure across industrial, retail, and office properties provides natural hedging against sector-specific downturns. Additionally, the ETF's methodology of selecting REITs based on both yield and quality metrics helps ensure that the portfolio consists of sustainable, well-managed properties rather than just high-yield but potentially risky investments. What are the main benefits of investing in the Lion-Phillip S-REIT ETF? The Lion-Phillip S-REIT ETF offers several key benefits for investors. Diversification. The ETF provides exposure to 23 high-quality Singapore REITs across various property types, including industrial, retail, and office sectors. This diversification helps spread risk across multiple REITs and property classes. Professional management. The fund tracks the Morningstar Singapore REIT Yield Focus Index, which screens for high-yielding REITs with superior quality and financial health. This ensures that investors gain exposure to REITs that meet certain quality criteria. Low-cost access. Investors can gain exposure to a basket of S-REITs through a single transaction, potentially reducing overall brokerage fees compared to purchasing individual REITs. Convenience. The ETF handles corporate actions like rights issues and rebalancing, saving investors time and effort in managing their REIT investments. Regular income stream. The fund provides semi-annual dividend distributions, offering investors a potential source of regular income. Geographic diversification. Over 85% of the S-REITs in the fund own properties outside Singapore, providing investors with exposure to real estate markets beyond the city-state. Liquidity. As an exchange-traded fund, it offers better liquidity compared to investing in individual REITs, allowing investors to buy or sell units easily on the stock exchange. Transparency. The ETF's holdings and performance are regularly disclosed, providing investors with clear information about their investments. While these benefits make the Lion-Phillip S-REIT ETF an attractive option for many investors, it's important to consider factors such as fees, taxes, and individual investment goals before making a decision. What sectors are most represented in the Lion-Phillip S-REIT ETF? Based on the most recent data available, the sectors most represented in the Lion-Phillip S-REIT ETF are industrial REITs. This sector has the largest representation in the ETF, accounting for 35.7% of the fund's allocation. Retail REITs. The second most represented sector, with 32.8% exposure in the fund. Office REITs. While the exact percentage is not provided in the search results, office REITs are mentioned as one of the top 3 sectors represented in the ETF. It's worth noting that the sector allocation may have changed slightly since the time of these reports, as REIT ETFs are typically rebalanced semi-annually. However, these 3 sectors, industrial, retail, and office, consistently appear as the most significant components of the Lion-Phillip S-REIT ETF's portfolio. How this ETF might fit into different investment strategies. For the income-focused retiree. Imagine you're approaching retirement or already retired. Your primary goal is to create a reliable stream of passive income to supplement your retirement funds. This is where the Lion-Phillip S-REIT ETF can play a crucial role in your portfolio. With its semi-annual dividend distributions and focus on high-quality income-generating properties, it's like having a diversified property portfolio working for you without the headaches of being a landlord. The ETF's current dividend schedule, with payments in February and August, can help you plan your retirement income more effectively. For the growth-oriented young professional, if you're in your 20s or 30s and looking to build long-term wealth, this ETF offers an interesting proposition. Think of it as buying into Singapore's premium real estate market at a fraction of the cost. While recent performance shows some challenges with a 3-year decline of 23.85%, this could present an opportunity for long-term investors. You can gradually accumulate units through regular investment plans, taking advantage of dollar-cost averaging. The beauty here is that you're not just investing in Singapore. Remember, over 85% of the underlying properties are spread across Asia-Pacific and beyond, giving you international real estate exposure from the start. For the balanced portfolio strategist, if you're someone who believes in maintaining a well-balanced investment portfolio, the Lion-Phillip S-REIT ETF can serve as your real estate allocation component. Traditional portfolio theory suggests having 5 to 15% exposure to real estate, and this ETF makes it simple to achieve that allocation. What's particularly valuable is how it can act as a partial hedge against inflation. Since property rents and values typically adjust upward with inflation over time, the ETF's mix of industrial, retail, and office properties provides natural diversification within the real estate sector itself. For the conservative investor, for those who prefer a more conservative approach to investing, this ETF offers several appealing features. The Morningstar screening methodology helps ensure you're investing in REITs with strong financial health and sustainable business models. It's like having a professional property analyst scrutinizing each investment for you. The regular income stream can be particularly comforting for conservative investors who prefer predictable returns over capital appreciation. For the global macro investor, if you're someone who invests based on broader economic trends, this ETF can be an interesting tool. Through its underlying REITs, you gain exposure to various property cycles across different countries. For instance, when Singapore's office market might be cooling, the industrial properties in Australia or retail spaces in Japan might be performing well. This geographical diversification allows you to participate in regional property trends without having to directly invest in foreign real estate markets. For the ESG-conscious investor, while not explicitly marketed as an ESG product, many of the underlying rates in this ETF are increasingly focusing on sustainable property management and green building certifications. This means you're often investing in properties that are being upgraded to meet modern environmental standards, which could be crucial for long-term sustainability and value preservation. The smart way to use this ETF. Regardless of your investment strategy, it's worth considering a staged approach to building your position. The current market conditions, with REITs generally under pressure from higher interest rates, suggest that averaging in over time might be prudent. You could start with a core position and gradually increase it as market conditions evolve, or as your investment needs change. What I find particularly interesting is how this ETF can serve multiple purposes in a portfolio, from being a pure income generator for retirees to acting as a growth vehicle for younger investors. The key is aligning the allocation with your personal investment timeline and risk tolerance.